What are some scientifically proven ways to increase the odds of success when investing? The average annual return from stock investing is 8%. Throwing darts at random companies on a dartboard and then investing in them will achieve this same return. And most financial advisors are happy to settle on that for their clients. Now, I've spent over 10 years compiling strategies and research to tilt the odds of investing success higher than this 8% and to reduce any attribution to just blind luck or matching the market. And what I found is that there are a few strategies and approaches that you can take to easily tilt your returns higher than the average return while also reducing risk at the same time. So in this video, I'll show you a few approaches to investing that you should be applying as a high net worth individual to reduce your risk and increase your odds of outperformance. So before I dive right in, I should quickly introduce myself. My name is Daniel O'Loughlin and I've over a decade of experience in the investment world. I'm a chartered alternative investment analyst. I was an investment analyst at S&P Global. I hold a Master's of Finance from Ireland's leading university, and I've published papers on predicting asset prices that made a significant impact in the field of investments and behavioural finance. But most importantly, I spent all these years studying markets and developing the tools and frameworks to outperform them, which allowed me to quit my job 4 years ago and manage my own personal wealth. So, after this video, you will know how to achieve investing outperformance using the same strategies used by elite investment managers. Let's dive right in. So the first concept that I'm going to talk about is using game theory or second level thinking. Applying second level thinking to investing has been the single biggest upgrade of my investing ability that I've encountered. Let me start with a quote from the legendary investor Howard Marks. If you think the same as everybody else, you're going to act the same way as everybody else. And if you act the same way as everyone else, you're going to perform the same. That's not a very good formula for being a superior investor. Most people think the same when investing. They hear something that sounds good about either the economy or an investment, and they make their decision based on that first level of inference coming from that piece of information. Then they continue to reinforce that same thought with additional facts that support that belief and discount any facts that counter the belief. Let me give you an example. A friend of mine who likes to invest came to me and pitched me the idea of investing in Nvidia, and he said it can't go wrong. The demand is crazy, which it is, and they recently announced their new AI chip, which is also going to cash in on this crazy demand. All of this is true, so you think, I should buy Nvidia stock. It's going to go up because it has all this good news. And let's say everything else about it is perfect, like their financials, etc. But here's the second level thinking. Everyone already knows that Nvidia is leading in chips, leading in AI, and they know of how much demand there is. That's why the stock is already at its all-time highs. This good news is expected, and therefore the smart money already bought in months ago when that chip was already in development. Now, that's not to say that Nvidia isn't a good buy right now, but I'm just saying that you have to think differently. You have to employ second-level thinking if you want to outperform. Now, to be honest, this is a life skill, and it's how you should be thinking about everything, from politics to your business to everything. So how do you apply second level thinking? Applying this type of thinking really is an exercise of the mind and gets better with practice. So first, you really need to sit and just think. You begin with the first order consequences, and when you're practicing this, you can even list these consequences on a piece of paper. For each first order consequence that you list, then you want to ask for each one, and then what? That's how you figure out the nth order of consequence. You keep repeating that question. Then you need to consider the aspect of time. Nth order consequences show up later after the first order consequence. So if you can correctly anticipate the timing of the second order or third order consequence, then you can profit. I'll create another video that goes more into detail on applying this. So if you'd like to get to that video, click the subscribe button and let me know in the comments if this is the kind of video or analysis that you'd like to learn more about. So the second concept I'm going to talk about is taking advantage of the power of liquidity. Liquidity in this case is defined as easily accessible cash that can be invested at a moment's notice. Now, liquidity is power during crises. Elite investors will often keep 10 to even 20% of their investment portfolios in cash or equivalents like money market funds, treasury bonds, that kind of thing. Not because they're bearish, but because they're opportunistic. Let me explain what happens during short-term crises, because once you understand this, you'll see a whole new idea around the concept of buying low and selling high. So it's important to first note that many assets are bought with loans. If you're not familiar with the investment world, leveraged finance is big business. Companies, real estate, and many other assets are all propped up by a huge global credit system, which many of us do know, especially considering what happened in 2008. Now, this is important to know, because what happens when one really large asset crashes? Well, other assets start to follow. The reason for this is because loans get called in, and to avoid bankruptcy, people have to sell their best assets to pay off the ones that landed them in this negative financial situation. Take notice to what I said. They pay off the bad performing assets by selling their best assets. This means that great assets get sold off during times of crises, which means opportunity for those with the liquidity. Very few people have cash positions during these times of market turmoil, which means you'll get the best assets at the best prices. This is why you always need to have a cash pile to take advantage of these situations. So how do you actually do this? Well, you simply keep your cash in the bank, or you can invest it in something that's very stable, like short-term treasury bonds. Now, maybe you already have too many assets and you don't have cash. Well, a good strategy is to start selling the assets that are performing really well. This is part of the buy low and sell high strategy. As assets are pushing higher, you can start selling them off in tranches, and then with the cash that you receive from selling these, you use this as your opportunity fund. So overall, then you'll be ready to pounce on opportunities when they strike. Now, the next concept that I'm going to talk about is heavily under-researched. However, having the knowledge of this has given me a huge advantage over investment markets. So overall, the concept I'm talking about here is behavioral finance. The biggest impediment to successful investing is your brain's natural wiring. Let me explain by way of an example. The first rule that everyone knows when investing is buy low and sell high. However, when markets become choppy or even negative, and then it's a good time to buy because they've come down a little in price, we actually tend not to buy more, and actually more often than not, we tend to sell out of fear. I've published a highly impactful academic paper published by the Capco Institute where I created an algorithm that could successfully predict cryptocurrency price movements based on analysing investor behaviour. If you'd like to see the paper or learn more about it, I'll leave the link in the description. So let's dive into what's at play here. I'm talking about behavioural biases. These are mental shortcuts and emotional reactions that causes us to make irrational decisions, and especially with investing. Instead of thinking logically, we're just naturally wired to rely on gut feelings, recent experiences, or social pressure, often without us even realizing it. And in investing, these biases can lead us to poor timing, overconfidence, panic selling, or even chasing hype, all of which can seriously damage long-term returns. But once you overcome these behavioral biases, you will instantly improve your investing. So how do you overcome this and instead use it to your advantage to outperform the market, who are generally falling for these psychological tricks? The first step is to study and become aware of these biases. So let's run through a few of these. There's the availability bias, where we'll use the most available and easy information to access to influence our decisions. The information mightn't be the best information or the most relevant, but because it's easy for us, the brain just naturally prefers the easier path. Another well-known bias to know is the anchoring bias. This is when we anchor our thoughts or beliefs on a small fact or a small amount of information, and we don't take the time to, let's say, remove the anchor and open up our beliefs to other possibilities. Then there's hindsight bias, where we believe that we knew what an outcome was going to be, even though before the fact, we actually didn't. Another very significant bias would be the confirmation bias. This is where we only seek out information that confirms our own belief, and then we end up discounting the facts that counters our belief. You'll see this all the time when discussing things like sports or politics, but it does also happen in investing. An example of where this can appear in investing is, let's say you own a stock, we'll say Apple as an example, and you will naturally find yourself reading or clicking into any of the headlines that say anything positive about Apple, or any of the YouTube videos that say why it's a good company to buy. However, what your brain will also do automatically is filter out anything that's negative, and unconsciously you won't feel a desire to look at any videos or read any articles that are negative about Apple. We're all wired in the same way in the sense of psychological biases, and therefore it's not something you have to feel bad about or angry with yourself over. You're always going to have these tendencies. Really what it's about is being aware that you're doing it. And so reflection over these thoughts and beliefs is what helps you get over these biases. Another bias is pattern seeking, where we might see order where really there's just randomness. And finally, another one is overconfidence. Oftentimes we think that we know more than we actually do, and that we're better at things than we actually are. That happens a lot in investing. You might think you're a good investor because maybe the last few months you've had a really good run, or maybe you've just started and you haven't been losing, or you haven't experienced a large drawdown, and you might start to think you have the golden touch. Then what happens is you will start to bet more, because statistically you're seeing yourself win more than you lose. You start to make more outsized bets and not really factor in the true risk. So anyways, the second step to overcome these biases is just to approach investing with these biases in mind. At first, you're probably going to continue to fall prey to some of these. So what you need to do is analyze the why behind all of your decisions, both during and after. You can then start to implement methods to avoid making these behavioral mistakes. You can either strengthen your knowledge of all the different biases that are out there to the point that they no longer really play much of a factor in your investing, or you can delegate to an investment manager who is aware of these biases so you don't have to take the energy or the time to have to learn them, or even worse, learn them through making these mistakes. You need to find anything and everything to reduce these emotionally driven decisions. Now, the next concept I'm going to talk about is momentum. It's one of the most overlooked and consistent strategies to achieve outperformance, and by applying momentum in a specific way, I'm going to show you how you could have caught Nvidia at $1 in 2016 before it rose to over $150 this year. So the general idea is simple. Assets that trend long-term to the upside tend to continue going to the upside. That's at least true in the medium term and more than likely in the long term. That's not speculation or making guesses. Momentum is backed by decades of academic research. It's one of the most well-documented anomalies in finance. Stocks with strong recent performance tend to continue outperforming. So let me show you how I've been using momentum to catch my biggest wins. Let's take Nvidia's price chart. The first thing about momentum is that the longer the time horizon you're seeing, the stronger the signal is, and the more likely that this method will be successful. Absolutely don't use this method for short-term investing. Secondly, the best way to analyze a chart for momentum is actually to remove the highs and only view the price from its floor. A slowly upward linear or curving price floor is one of the best signals that you can discover for a stock that's possibly going to explode. So the period from 2009 to 2014 confirmed the price floor that's been established since 1999 through the 2000s. And then in 2014-2016 provided such a low risk buying opportunity. The price was continuously going upwards against its price floor. It wasn't falling below it, and eventually it turned parabolic. As you can see in this logarithmic chart of Nvidia, after 2016, the price exploded and you would have had the potential to earn exponential returns. Now, another little tip is that high growth opportunities are best plotted on a logarithmic chart, since putting a stock like Nvidia on a linear scale chart just gives you nearly a straight line up, which makes it very difficult to analyze in terms of long-term price action. So, using momentum in this way lets you get early into a high growth asset, giving you a low risk buying entry and a chance to ride the stock before the crowd fully wakes up. You tilt the odds sharply in your favor. Now, the final concept that I'm going to talk about is an easy one. It's time in the market. It's the easiest edge you'll ever get in investing. You don't need complex models, macro forecasts, or hedge fund level access. You just need time in the market. Why? Because markets are structurally biased upwards. Companies reinvest profits, innovation compounds, productivity improves, and governments are incentivized to keep things going, not to crash the system. Now, here's the insight that most investors don't internalize. It's not timing the market that's important. It's time in the market that matters. Let me give you a stat that should rewire how you think about investing. If you missed just the 10 best days in the market over a 20-year period, your total returns would drop by half. And the crazy part, those best days tend to come right after the worst ones, which means if you sold out during volatility, you miss the rebound. So how do you tilt the odds in your favor? You stay in the game. You build up a portfolio that you can hold through cycles, you follow your investing rules, and you stop trying to jump in and out based on fear and headlines. Just like with momentum, the edge comes from compounding. The longer your capital stays invested, the more it benefits from compounding returns. And then the less you need to rely on being right in the short term. So if there's one thing that you should take from this video, it's this. As long as an asset or an investment remains a solid investment, the easiest way to outperform is to never sell the asset only until something about its long-term future becomes inherently bad. So I hope the video has been educational for you. And if you're a high net worth individual or entrepreneur and you want to build an investment portfolio based on experience, knowledge and data, that's exactly what I help with. So click the link in the description or visit senecaprivate.com/apply, and I'll see you in the next video.